Good evening everyone and welcome to Admiral Markets webinar. Today is 23rd of April 2015. My name is Nenad and today Chris is with me, so we will be explaining why using 80-20 rule is useful in trading. We will talk about Pareto's principle or Pareto's law, and I will give the introduction to the main subject, and then Chris will continue. Before we begin, as always, our standard risk disclaimer. Risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with us. Online education materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence and contact an appropriate entity. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the authors, me and Chris, and in no way it represents the actual suggestion for the trade. These are not MK's opinions, and the website individual is not a .co.uk website but a globalnews.com website. Forex is risky business. This should be taken as personal opinion, and this webinar is for informational, educational purposes only. Just a quick reminder, this bonus campaign will last till the end of this month, so grab up to 50% of bonus on deposit for new and existing clients. 0.25 lots should be made per each euro bonus, and you have 180 days to complete. By clicking at this link, you can actually see what the bonus is and how much you can get. So, today's Pareto's law, rule, theory, and 80-20 in Forex market. That is what I will be talking about. And then Chris will take over and he will share his statistics and opinion. So, the introduction to Pareto's law, exactly who was Pareto? Maybe you didn't hear about it, but in the year of 1906, so in the year of, at the beginning of the 20th century, Italian economist Vilfredo Pareto, he basically created a formula which described distribution of wealth in his country. And basically what he observed was that 80% of the lands in Italy were owned by the 20% of the population at that time. So 20% of the population in Italy basically owned 80% of the overall lands in Italy. Then we need to say that in the late 1940s, Dr. Joseph Juran, he basically thought that 80-20 rule is definitely Pareto's rule, and he called it Pareto's principle. Maybe Pareto was not the first person who created 80-20 rule, but because of Dr. Juran basically giving Pareto credit to that principle, it's named Pareto's principle. Okay, maybe it is misnamed, but Pareto's principle or Pareto's law basically is very good tool that can help you to manage accounts effectively or your account effectively, unless of course you mess up your account because of your psychology or revenge trading. Now we need to say that basically Dr. Juran's observation or Pareto's law imposed basically viral few and trivial many principle, and that means that universal principle, which is called viral few and trivial many, is exactly describing 80-20 rule. He basically also applied Pareto's observation about economics to a broader spectrum of work. So it's not just about economics, it's also about other things, and we will specifically see how these things can impact Forex trading. Now, what does it basically mean? Again, we need to be clear with this. 80-20 rule means that in anything, a few, let's say 20%, are vital and many, 80% are trivial. Okay? In Pareto's case, that was 20% of the people owned 80% of the wealth. In Duran's initial work, he identified that 20% of the defects basically caused 80% of the problems. So he identified those defects or mistakes within 20% of the products, and those caused 80% of the problems. Now think about that in Forex terms. 20% of the time you may not be right, but 80% of the time you are right. But that 20% is probably causing you problems in trading. And I specifically know what are those problems. When you lose, you tend to do revenge trading. You don't respect your stop loss. You are trading instead of 30 pip, you are putting 100 pip stop loss, and you're using over leverage. Everything else is fine. You have good system, you have good method, you know which daily levels of support and resistance are, but somehow you do the analysis correctly, but somehow you don't respect it. And it does not have to do always with you. I will go to that later. 20% of the work consume 80% of our time and resources. What does it mean? It means that the first 10% and the last 10%, it's 20% of the work, consume 80% of our energy and resources. Okay? So you can apply that 80-20 rule to almost anything, from the science of management and Forex market to the physical world. 80% of one company's profits come from 20% of its customers. Rule of minority. Okay? 80% of company's profits come from 20% of its customers. 80% of company's complaints come from 20% of its customers. And 80% of a company's sales come from 20% of its products. Think about this when you trade. Think about this. How it can help you. The value of Pareto's law basically is that it reminds you to focus on the 20% that matters. Okay? So you need to focus on 20% that matters. Okay? Those 20% produce 80% of your results. Identify and focus on those things. Okay? 20% produce 80% of your results. So it's not 80% which you need to be focused on, it's that 20% which you need to focus, and it needs to attract your attention. Okay? Now, this is Pareto's principle on diagrams. 20% of one's input, which corresponds to time, resources, or effort, accounts for 80% of the output. It's normal, it's a standard input to output diagram. Okay? It's normal, it exists in every single perspective, even in our everyday life. Okay? So 20% of your time, resources, effort will give you 80% of the results or rewards. Okay? In measuring your value, so 80% of sales comes from 20% of customers. 80% of productivity comes from 20% of activity. 80% of profit comes from 20% of products. 80% of referrals comes from 20% of clients. And 80% of commission income comes from 20% of orders. Okay? And in measuring frustration, you will experience 80% of absenteeism from 20% of employees, 80% of errors from 20% of workers, and 80% of servicing problems from 20% of customers. That is Pareto's law. Okay? So you need to focus on doing smart things. Okay? Work right on the smart things. Identify your problem which corresponds to that 20%. When you identify the problem, that means that you are a step closer to a solution of the problem. Okay? Focus 80% of your time and energy on that 20% you think it's important. Okay? So focus 80% of your time on 20% you think it's important. Okay? Now pay close attention. This is related to Forex market. Okay? How? Having a method or system which gives you 8 out of 10 wins, it's good, but it can easily negate it. Okay guys, pay attention. This is a good system. It gives you 8 out of 10 wins. But what if your psychology messes up with yourself and your trades? Example, 100 pip win with 0.3 lot can easily be killed and negated by 30 pip loss losing trade with trading one lot. So that would mean that you are 70 pips in a profit, but your account will show a loss. So the account will show that you have 70 pips, which is good, but instead of profit, it will be a loss. Okay? So method which gives you 8 out of 10 trades is not enough. It is definitely not enough. Knowing 20% of take profit points that gave you 80% of the return. Which pair? When it gave you those 20% of take profit points? When? Look in the history. Analyze those pairs. 20% of stop losses, of stop loss points that gave you 80% of your loss. Why did you make 80% of your loss with just 20% of your stop loss hit? We come to the first point here. Okay, to the first point. You may have a good system, but maybe you made a trade with 100 pip stop loss instead of 30 pip stop loss. So 20% of stop loss points usually will give you 80% of your loss. Why? Because you didn't respect your system, you didn't respect your management. Okay? 80% of profits, guys, comes from 20% of wins. You will be probably very, I can say, confused with this. But just analyze your trades. 20% of your wins probably gave you 80% of your profits. And what were those wins? What were those wins? Were those wins revenge trading? Were those wins reversal trades? When it hit your stop loss, you usually go in counter direction and make profits. Analyze this. Maybe it's your way how to trade it. Maybe 20% of those wins were simple intraday setups which you do every other day. You need to analyze it. 80% of the time you will lose due to revenge trading. Again, 20% of those wins probably were not due to revenge trading. But 80% of the time, you will lose due to revenge trading. 80% of the time, you should not be in the trade. 20% of the time, you should. Think about the analysis which I presented yesterday on euro-dollar. Think about it. This is a good example. I will pause my screen and I will show you exactly. I just need to find the chart and I will show you how to actually see that on the chart. So this is basically it. Let me move my screen. Okay, and this is it. Okay, think about it, guys. 80% of the time, we should not be in the trade. Yesterday, if we use this 20% of the time, which basically was only 20% of the trading time, euro-dollar spiked up, okay? It was only 20% of the overall time. It happened in London session. Euro-dollar spiked as we presumed, basically, and then what happened? It hit this point here and suddenly started to reverse, okay? Now, if we knew that we should not buy yesterday euro-dollar on intraday level, we would probably be safe, okay? Because what happened? Euro-dollar started to fall. Euro-dollar started to fall. It came to buying zone, buying level. Yes, it was rejected from this point, but we were a little bit scared because exactly what happened, euro-dollar was very close to important level of support, 0.659. If we knew that, we probably would avoid it. But what happened? S&P yesterday announced probable negative rates on pension funds, and basically they again intervened in Forex market, effectively selling euros. And what happened? Dollar, or buying dollars, because they frequently intervene in dollar market now. So they bought dollars, euro-dollar went strongly to the downside, and today, again, what happened? Euro-dollar, as I presumed, was bought in the dips. I said yesterday, my view on euro-dollar at this point hasn't changed a bit. As long as there is possibility of a mutual agreement between Greece and Eurozone, the pair should be bought on dips. Yes, today we had basically buying on dips. Buying on dips. And exactly 20% of the time, basically, we use that to buy euro on dip. That single dip happened at the start of a London session. Okay? What happened after that initial time? The euro-dollar just went up, 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 hitting 80.20, and there is possibility that it will go to 80.50. So 80% of that time we should avoid yesterday. 20% of the time we should be in the trade. And when is best trading time? Best trading time is always the first 3 hours of each session. Usually, in the meantime, if you go for a trade, there is big possibility that you will be stopped out, because the best movements happen during the first 3 hours of each major session. London session, New York session, and of course Tokyo session, okay? Now, that is 80% of the time you should not be in the trade. Use Forex trading hours. First 3 hours of each session. It's my rule of the thumb, and 20% of the trade and 20% of that time will usually correspond to those first 3 hours of each session. 80% of the time you should watch your position if you trade on intraday basis, because very often your position may be in a good win, but then bang, you can be stopped out just to be subsequently, just for the price to subsequently goes in your direction. It happens very often. Bad news for pound today, pound dropped, then it was bought heavily. 80%, and now this is important. In my opinion, maybe this is the most important part of trading. 80% of success is money management, and 20% of it is a system or a method. Okay? You're in big advantage if you have a good, successful system. But if you don't go with proper money management, eventually that system cannot help you to cope with losses. So 80% of success comes from money management, while 20% comes from a system. Okay? So you should be focusing about 80% of your trading efforts on money management, okay, and controlling yourself. That means that you should be disciplined. It has to do with psychology. And you should spend about 20% on analyzing the chart. Okay, we are here to help you. Our team, me, Chris, other guys who go with Admiral Markets, we are analyzing the charts for you. And it's okay. Maybe we will not have that time to trade, but that is why we do it very, very fervently to present you with good setups and good analysis. That means that we spend about 80% of our efforts to scan through pairs, to do the analysis, and to explain the analysis. But we have less time on actually trading. So you should focus yourself, because we help you with our analysis. You try to focus yourself on trading and money management and controlling your psychology, because psychology is what 80% of success comes from. You can have a good method, but if you don't know how to control your wishes and your emotions, ultimately you will lose. Okay? Very important thing is to remember, okay, that using effective trading method is good, and it will give you mental discipline and time to focus 80% of money management. Okay? So a lot of traders will never get to that point. From my experience, really big success was always followed by good wins, consistent wins. And that is because I do trading with my method and I respect my psychology. If I step away from that psychology due to various factors, even myself I can lose trades. Okay? So focus 80% on money management. Try to do that correctly. Unless you want to gamble. I always say, yes, you can gamble if you have money to spend. Then okay. Maybe you will have a luck in that. But if you want to do it properly, then 80% is definitely money management and 20% is system. It will always boil to the numbers again. Forex market, guys, is basically based on money movements. It is measured on price dynamics between currency pairs. By that, the interdependence principle, which we call Forex correlation, that price dynamics involves the pairs dynamics among all currency pairs. Okay? Now, I will say few more minutes, then I will hand over to Chris. It's about the numbers, okay? So interdependence principle in Forex market is what we call Forex correlation, okay? Now, the price movement in Forex market is done by three factors. The economic announcements, which are usually seen in news calendar, then central bank or government interventions in the economies, big banks, multinational enterprises, and institutions. Okay? 20% of those factors are responsible for 80% of the market movements. Pareto's law. Okay? Pareto's law or principle. So, the economic announcements, which can be seen in news calendar, central bank interventions, okay, in various economies, okay, big banks, multinational enterprises, and institution decisions. That will go with 20% of factors, but those factors, which are minority, are responsible for 80% of the market movements. That relation, 20-80 or 80-20, we will also find in many aspects in Forex trading. The indicators, the ratios, okay, even with the news calendar, okay, when we watch news calendar, we go for deviation. So that deviation usually has a significant differential between the previous and the forecast numbers, okay? So that is basically how we can think about Pareto's law in Forex market. Now Chris will continue. I will hand over the presentation. I think, yeah, now Justinas is saying few months ago, I read a book about it, Brian Tracy, Eat That Frog. Yes, probably I have heard about the book. I think it rings a bell, but I'm not sure that I read it. To be honest, I just explained this Pareto's law. I don't have much time really to read about all those good things now, and because I focus my foreign energy or other things. Goran is saying, can you show few slides from the beginning? I was a little bit late. Goran, basically I explained Pareto's principle and Pareto's law, and I think that Chris will probably repeat some of those for all of you who entered a little bit late in the webinar. So basically the thing is, Goran, that 20% of defects causes 80% of the problems. Okay? All those things, 80% of companies' profits come from 20% of customers. 80% of companies' complaints come from 20% of customers. 80% of company sales come from 20% of its products. This is Pareto's principle. And in Forex market, okay, for me, the biggest thing is 80% of success is money management, 20% is system method. Okay? Because it boils to this. Especially if you have a good method, it's good. But if you don't do it with proper money management, you can lose 100 pips with only 30 pip. Because you were out of luck. But that is the law. That is the law of nature. Okay? You need to be disciplined. Okay? I already am running out of my time, so I will hand over to Chris now. I'm sure that he will mention good directions and important directions of 80-20 in the beginning of his presentation. So for all of you who are a little bit late, do not worry, this webinar is recorded, it will be uploaded, and Chris will also explain his views on Pareto's principle. Okay?
Definitely. Thank you so much. Great stuff. And let me get the screen sharing going.
Thank you, Chris. You can continue.
Yeah, thank you, T. Great stuff. I think that actually a lot of important things have been mentioned. The 80-20 rule, what it is, and how we can use it in trading. So in that regard, maybe not much to add, but I think that we'll bump into some things that we could still think about. Of course, the 80-20 principle just in general kind of makes your mind search for connections and potential relationships between elements in trading. It's basically tinkers with our curiosity, like how could they be interacting, how can they interact with each other. And I think that's the good thing about this theory. Of course, we have to still remain a bit with our feet on the ground. I mean, we could over-combine things, over-analyze things, and we might get a bit too fancy in that. But in general, if we keep it straightforward, I think we can improve and use it as a useful analysis and kind of use it as a creativity to find connections that might help us improve our analysis. So I will try to help with that. Then I already gave a few great examples, and I'll try to foster that, to help that by thinking with you how we can use this principle and law to analyze our own trading, because that's of course why we're discussing this at the end of the day. Before I do that though, I don't want to discuss the details exactly, but the 80-20% principle is basically, according to probability theory, it's very unlikely that it's a random occurrence. It's something that is probably not just happening out of the blue, or it's not something that just by coincidence occurs. The probability theory states that that's virtually impossible. The 80-20 principle, therefore, is not occurring randomly. That's the point. If you want a source, it's in the 80-20 principle book written by Richard Koch, who's the author, on page 13. So we have to take it seriously. It's not something that is just a random element, all right? Now that we know how important this theory is, basically, indeed, as Nan had already explained, but for those that maybe came later, the 80-20 numbers explain the fact that 80% of the outcome is caused by 20% of the ground causes. So 20% of the products cause 80% of the profits, or 20% of the customers generate 80% of the revenue, right? It's basically the minority of the minority causes 80% of the outcomes, basically. Now these 80-20 numbers are examples, right? The idea is just the minority versus majority, right? The numbers could be different. If you find out that it's 18 versus 82, or if you find out that 25% of the customers generate 67% of the profits, it's still the same. It's still the 80-20 rule. Just because the numbers are different, just because the numbers are, 25 and 67 in this case, that's fine. The point is that a large majority comes from a small kind of minority. That's kind of the idea, all right? So they don't even have to add up to 100. It's done because of the fact that it's easier to remember. It makes the kind of the theory easier to keep in our minds. But they don't have to match 100, and they don't have to be exactly the 80 or the 20. All right. One more practical example. Let's say that 90% of the complaints come from 12% of the customers. They don't add up to 100, and they're not 80-20. All right. That's just an example. So the units of effort are not equally important. That's basically the whole idea. But in our minds, we think that it is so. We tend to think that each unit of our efforts are equally important. And we overemphasize the ones that are less important, and we underestimate the ones that are more important. It's just a natural tendency for us to equally kind of evaluate and appreciate our efforts and time. Well, unfortunately, this is, well, I don't know if it's unfortunate or not, but that is just not so. It's not reality. So that means that we're not efficient in how we tackle our day, our trading. So inputs, 20% of inputs cause 80% of outputs, 20% of causes, 80% of consequences, 20% of effort goes to 80% of results. Now this is something that Ned already talked about, so I won't dive into too much, but basically by using it, we can be more efficient and better focused. We can focus and invest our resources, time, and energy into better things and actually become smarter with our focus. In regard to trading, I think we can find four kind of topics. We can find four kind of elements where we can apply this 80-20. Trading performance, individual performance, the market itself, and the strategy performance. So be kind of asking questions and talking about the 80-20 principle with these four things in mind. Trading performance. Ned has talked about some of these things, but the losing trades, are they caused by the same mistake? Perhaps 70% of the losing trades are caused by 12% of the same mistake, for instance. Is there a certain element of trading psychology like fear, impatience, discipline, revenge, or hope that is causing us to repeat certain behavioral patterns that lead to these mistakes? These are kind of questions that we can ask ourselves when analyzing our trading and our trading performance. Do the losses typically come from a few trades, and why? What has happened with those particular trades? Why did they generate the most losses? Is there something that links them together? Is there some common characteristic that could explain those losses? Do the majority of losses come from a small number of days or a small number of hours? Do you have most of your losses coming from the London Open or from the after the London or in the Asian session? Are most of these winning trades cut short because of emotions, for instance? So we can look at our wins and losses to determine if there's any particular relationship between money management, trading psychology, analysis, entries, exits, and trade management to see if there's any underlying kind of analysis that could explain and improve our trading. All of these factors can be kind of linked together and analyze if there's anything that connects them. All right, so that is trading performance. Anything from entry to trade management to trading psychology, risk, money management, basically, in my opinion, we can all analyze it to see if there's anything that can explain a large part by a small group. Individual performance is more our personal effectiveness. This is how we manage ourselves and how we manage our time. Now, individual performance, in a way, could be also linked to trading psychology, but in general, also to how much time we spend on tasks. For instance, Nana's already mentioned it, do we spend 80% on finding an entry? Do we spend 80% of the time doubting our analysis, for instance? Do we spend 80% of the time scanning the charts, but not really focusing? This is how we can critically analyze how we spend our time during the day. Do we focus on education, but really only look at finding kind of a perfect system? Do we overemphasize the entries but neglect the exits and trade management? How much do we really benefit from each of these tasks that we do regarding trading and connected to trading? Are we trying to find a perfection that is difficult to find, right? Don't forget that often enough, if you really want to go for the 100%, it's very cost inefficient. If you aim for 90%, it requires perhaps 20% of, or 30% of the energy. But to get the last 10% of perfection, you need an 80% of effort. And that's probably a balance that's not, in the long run, I don't think it's beneficial. It's perfecting it too much, and I don't think it leads to a good balance. I think it's better to aim for good, but not perfect. It's more efficient. That's another way of applying 80-20 to your personal efficiency when performing tasks, because our routine, basically, what we do during the day, day in, day out, are the building blocks for our success. If we don't use the time wisely, we will not get better, we will not improve in the long term our strategies and our performances. So if we make sure that we use our time and beneficially, then it has a long-term, a good long-term effect. What actions, last one, the third one, what actions are the most beneficial for our trading? Then we have the market. Market, of course, I mean the price and the charts that we have when we're looking at the euro dollar. In general, when we're looking at market, are there some particular correlations here that could be explained by the 80-20 rule as well? Perhaps yes. Now, we don't know the exact numbers here too, but typically price is often in the middle, and it's not often at the extreme, at top or bottom. Maybe, let's say, 80% of the time price is indeed the middle, and 20% of the time it's at extremes. Perhaps 80% of the time price is ranging, but only 20% of the time price is trending. And maybe 80% of the time our profits are from trending modes, but it only happens 20% of the time. Whereas 80% of our losses come from ranging. It could be the opposite as well, by the way, but I'm just giving you an example, right? Indeed, most of the time the market is ranging. This is something that, too, could be explained by the 80-20 rule, perhaps. The behavior and the type of movement that we see in the market. So we see that price is often in the middle and is often ranging, right? 80% is in the middle and 80% is ranging. So if we multiply that, if we multiply 80% times 80, what do we conclude from this rough formula, obviously? 64% of the time price is ranging and in the middle. Roughly, once again, right? We also conclude that it's at tops or bottoms, and trending, well, that is then 0.2 times 0.8. It is, what is it, 16%, right? And trending in the middle, it doesn't happen too much, I guess. Maybe that's a bit exaggerated. According to this formula, that would be only 4%. No, this is 80%. Excuse me, I have it the wrong way. Extreme, which is at 20. Sorry, it's the other way around. Made a mistake. I hope someone caught my mistake. This is only 4% actually, right? Trending and an extreme, only 4%. So we can see that that doesn't happen often. We don't get reversals that often, 4% of the time. But in the middle trending, that would be actually 0.2 times 0.8, and that would be actually 16%. And then the other 16%, I guess, let me calculate. The other 16% would be at an extreme and ranging. Well, anyhow, it's just to give you an idea. How about the market noise versus actual signals? How many times do we really have a good signal? How many times do we jump in a trade where the market is just noise and doesn't really provide a signal at all? And that happens so often, right, that we see and think or look and analyze, but in fact it's not much of a signal at all. 80% maybe is market noise, 20% is maybe a good signal. Or how about the consolidation and impulse, which is maybe the same as middle and extreme, or trending and ranging, but same thing. Impulses happen rarely and quickly. Consolidations take long. So where would it be perhaps easier to exit and enter? Which trades would go faster? With an impulse, right? Those only last perhaps 20% of the time, whereas the consolidations last a lot longer. So here too, we can use that kind of idea to understand the market structure and the price movements more. TP is just an abbreviation for tops and bottoms, as an explanation what the extremes mean. So with extreme, I mean tops and bottoms. Then we have our strategy performance. And that's maybe a bit the same as the first one, which was our what was, let's see, the trading performance, yeah. So, but anyhow, the questions we can ask. Majority of trading opportunities perhaps occur at similar points. Do the majority of our wins, are they generated by minorities of the entry types? For instance, we could take breakouts, confirmation trades, or pullbacks. Do pullbacks do a lot better job of winning? Or are the breakouts doing better in your type of trading? Perhaps you'll notice that it's actually the confirmation entries that generate a lot more wins than the breakouts. How about the filters? Are there a majority of filters that really are not that important? Maybe you're using 7 filters, but only 2 really have an importance on and actually impact the performance. Are a minority of tools and indicators that have the most important impact on strategy? Perhaps you're using 10 tools and indicators, but only 2 or 3 have the most and core value in your strategy. Here again, using the 80-20 principle, we can try to understand and critically try to understand our trading plan, critically look and analyze how the 80-20 impacts our trading plan and strategy plan to see if there's anything we can do to make it more efficient, easier and simpler to implement with better effect, and therefore hence better results and hopefully more profit. So that's how I see it. My goal here was to generate kind of curiosity and so you see certain relationships and you see potential things you can analyze yourself. Obviously, the next step would be to take these ideas and take a look at your trading evaluations and scorecards and Excel sheets and try to see if there is something like that. Perhaps you will see things that we didn't think about. So my question to you is, perhaps have you ever used the 80-20 rule, first of all? And have you ever used it in Forex trading? Just out of curiosity, we can discuss any observations that you perhaps have already noticed and throw it into the group here. So if you did use it if you ever used the 80-20 rule for whatever reasons, for business, maybe your personal life or whatever, let us know. And if you ever used it then specifically for Forex, drop a chat in the chat box. All right, so we can discuss that together. So to wrap it up, basically the idea is to encourage you to use the thinking caps about the cause and effect, about trading and the way of doing things, the analysis, the performance, all of it. Right? Once again, just to highlight not only our trading, our own trading, and how we implement our trading, but also our trading plan and how we formulate the plan. Right? It's always about 2 things in trading. It's about our trading plan and the execution of the trading plan. So with the trading performance, I mean basically execution of the trading plan, and the trading plan, I mean the formulation of the trading plan. These 2 things. Then, of course, we can use it for individual performance and effectiveness, and also about understanding the market. Right? So it encourages us to use the thinking caps. And the 80-20 rule, I think, allows us to focus on how we enjoy trading, and with focus we can be in the flow, we can learn better and quicker and retain the knowledge and experience a lot faster, and we can direct our attention a lot sharper. Minimizing distractions, very important. Maybe, perhaps, in 80% of the time, we're distracted, right? Or our losses derive 80% of the time when we're distracted. Focus is very important as a trader, that we're not getting sidetracked by TV, social media, internet, unless, of course, you're looking for something specific of help to your trading, right? It doesn't mean that you cannot go to social media if you're looking specifically for analysis, right? But if you then sidetrack and look 30 minutes at the wall of someone and then look at a video that is not about trading, and you're 1 hour later, then you lost the focus. All right, that is, I think, it from my side. Any questions in general? I see that no one has used the 80-20 principle. At least no one has written that so far. It's, I think, a very useful concept, and I would definitely recommend to take a look at that book, the 80-20, what was it, 80-20 principle, I think, if you're more interested in this topic. And I think you will find that an interesting book if you like this topic. It's called the 80-20 principle, pretty easy. Richard Koch is the author. So take a look at that if you are interested in more follow-up. Justinus writes, I'm trying to use it in my life to save time, for example. Yeah. Justinus is using it for individual performance. Great stuff. Indeed, how can you perform the task itself? Indeed, not only is a good point, I didn't even think about it, not only about what time you spend on the task, but how can you make the task itself more efficient. Maybe there's a quicker way to finish the task that will save you 80% of the time. Let's see, some questions. How to use 80-20 rule in trading, and how to use placing order using this rule. Well, the 80-20 rule in trading is kind of what we discussed already, is the trading performance and the your trading itself and your trading plan, right? That we just talked about. And how to place pending orders using this rule. Well, you might want to for instance, you might want to look at pending versus market orders and how good these orders do. Perhaps you'll find out that pending orders do a lot worse job than market orders, or the other way around. So that's something you could look at. Perhaps the type of entry, right? How you enter. I personally, maybe others see more types of entries, but I see 3 types of entries typically: pullbacks, breakouts, and confirmations. With pullbacks, I mean price goes back to a 50 fib, for instance. With breakouts, price is breaking above a resistance or support, and you take the entry above that or below that, above resistance or below support. And with confirmation, there's some price action, candlestick confirmation, for instance, that is showing the break or the confirmation of a bounce or break. So maybe, depending on how you trade, you'll see that one of these 3 is performing better. Right? I use triggers in my trading, for instance, and I use certain type of candlesticks. Perhaps when you analyze, if you keep track of that, of course, at least, which type of candles is the pin bar? Is it a doji? Is it a bullish engulfing candle? Which type of candle are you taking as a confirmation? Maybe perhaps you'll see that pin bars are not working that well for you as a reversal trading. And maybe when you dive into the details, you'll notice that certain pin bars work well, but the others not. Maybe pin bars that have not a strong enough reversal close are not doing as well as pin bars that have a strong reversal close. So every time you get one answer, you might ask another question that pushes you to another answer. and hopefully to another improvement. Now, there is kind of a border here, obviously. I mean, if you eventually go into too many details, you'll get down to a point where you're looking at 3 trades, and then it doesn't mean much, right? We still need a reasonable amount of data before we can make serious conclusions. If we conclude that, you know, this one pin bar didn't really do well for us, and we make too many conclusions about that, or any conclusions about that, it doesn't mean anything, of course. So we still need to keep that in mind. Let's see, can I decide to enter or not enter the market in direction use this 80-20 rule? If yes, then how? Can you give some example? All right, let me pull up a chart. For instance, 23.6 and 38.2 fibs, for instance, those are Fibonacci levels that, in my opinion, did not give me enough reward to risk in general, so I'd rather not take pending orders at those levels, right? That is an example of deciding to enter or not to enter the market with a particular placement of an order. Here, for instance, let's see, this is the euro dollar. Let me go a bit more to modern time. Here was a breakout, for instance, but it was a breakout that didn't have a candle close above the fractal. You can mark that, for instance, as a break, but without a close. Maybe you'll see that, and this is not something I know, I have not measured myself, but I'm trying to come up with an example, besides the fib example, that perhaps you'll see that a candle close above the fractal leads to a better result. It is something I look for myself, but I've never ever looked at the data on that myself. But it is something that I typically regard as a stronger break if you get a candle close above the fractal. That could be something to look into. Right, in this case, you see that we got a steep retracement against us after this break here, where I have this line. Although ultimately, depending on where you put the stop loss, the euro dollar is still pushing up, isn't it? Because I didn't break this bottom. So I've used it specifically a lot on pending orders. I like, therefore, personally, market orders more. I like confirmations at how do you call them? I'm looking for the word, at decision spots, right? That is what I personally found in my trading to work better. So market orders, decision spots, triggers at decision spots, and confirmations that price is indeed stopping at those levels that I think is important. So although I use fibs a lot, I use it more for an indication as a trigger than for pending orders most of the time. This is what I've built in my trading plans as a result. But for you, maybe it could be different, right? Everyone has their different psychology, different approach, different tools and indicators. So what I've experienced doesn't mean that you will have the same necessarily. So me personally, this euro dollar was bullish as well. For instance, let's see how far it can get. Well, yeah, that's a different topic. But I think 108.50 is the top, obviously. Then 109.50 is a target. 110.50 is a target. So let's see. Anyhow, if there are no other questions, then let me share with you the webinars we have for next week. We got recap, weekly FX recap with Nennet on Monday, trendline trading on Tuesday morning, and Forex strategy on Wednesday morning. Wednesday evening, Nennet is going to take a look at Heikin-Ashi price action strategy. And then Thursday, Nennet and I are going to take a look again at a different topic, but now how to use indicators and tools. All right, so we're going to take a look at how to distinguish the good and bad ways of using these indicators. And perhaps we can use that 80-20 rule again, but specifically on indicators and tools. Alrighty, no questions so far. So thanks again for joining. And if you do use this and you find out some interesting stuff, conclusions about your trading, then let us know. We're always, of course, glad to find out if these concepts helped you and how they did or not. And always curious about that. So wish you good trading tomorrow or later today still perhaps, and see y'all soon. Cheers.